Requirement C. Prepare the income tax note to the financial statements of Impact Limited. Refer client 4 for the year ended 31 December 2020 as required by IS 12 paragraph 79, 80 and 81C1. Okay guys, immediately when you identify 81C1, you need to know that you need to include your recon, tax rate recon. Guys, you are able to open these paragraphs and view what you need to do. But my recommendation is please take a little bit of time and study the templates and the principles. Therefore, you can immediately start to attempt the question. Communication skills, 1 easy mark. Comparative figures are not required. The movement in your temporary differences should be based on the statement of financial position method, and your answer must comply with IFRS. Okay, so plan of action as always. When you look at the bottom of your screen, I will include my templates. Therefore, when you refer to a new page, indicate that this is your part C, and I've included my template in terms of my income tax expense note. Okay, so remember your income tax expense consists out of your South African normal tax, your deferred tax, and your foreign tax. And we need to remember to include our tax rate reconciliation. Now, what I also do immediately, I will indicate that my current tax calculation will be performed in calculation number 1, and the movement in terms of my temporary differences of my deferred tax will be included in calculation number 2. Then on a new page, I will include that this is my calculation number 1, this is my current tax. And on the next page, I will include calculation number 2, my deferred tax. Therefore, this is my template, right? Or not scenario, sorry guys, I'm busy with the steps. We've included the steps. Then I will refer to the scenario and I will work through the scenario from the top. I will identify information that should be included in my current tax calculation and my deferred tax calculation. But remember, we need to complete our deferred tax calculation to be able to include our temporary differences in our current tax. Okay, now let's refer to the scenario. When we look at the scenario, our first paragraph here is a bit of background info, and then they indicate to us that you are currently reviewing the financial statements of Impact. Your assistant has presented you with the following schedule of information relating to the year ended 31 December 2020. Right. Item: Impact's accounting profit for the year ended 31 December 2020 after correctly accounted for all the items below is 6.9 million. Guys, immediately I will transfer this to where I need the amount. First, my tax rate recon. I know that I will start off with my accounting profit, which is the 6.9 million. I'm able to remember that they've indicated to me that this will be taxed at 28%. Therefore, I will calculate this. This is my easy marks, 1932000. Therefore, it's the 6.9 million times the 28%, right? Then, to be able to calculate my current tax, immediately I will include this, the profit before tax. Okay, then let's refer back to our scenario. We've ticked off that amount. Next, dividends received. Dividends received are exempt from normal tax in terms of section 10(1)(k). Therefore, for accounting purposes, this is included, but for tax purposes, we need to take this out. Therefore, we need to take this out when we calculate our current tax. Therefore, in calculation number 1, we have our dividends. Remember, this is a calculation, therefore you are allowed to use abbreviations. And this is an amount of 89400. Remember, we need to take this out. Let's tick off our amount. Next line item, foreign income received after deducting 6,000 relating to foreign taxes. Okay, so let's just stop. We have foreign taxes of 6,000. Immediately we remember that this should be included in our income tax expense, the foreign tax they've provided us being the 6,000. And then when we refer back to our scenario, the foreign income is not taxable in South Africa. Okay, Now, look at this, guys. What happens here? For accounting purposes, they've included the 42,000. Okay? But for tax purposes, this 48,000, which is the total income, the 48,000 is not taxable. Now, what do we need to do here? We need to take this out because we've already included the 6,000 in our income tax expense. Therefore, do you agree with me that this 6,000 will be included in the total? Okay. Therefore, in our current tax calculation, we have our foreign income now this is the 42,000 plus the 6,000 that we need to take out, and this is 48,000. We are able to tick off our amounts. Right, next item, gain on disposal of land. Impact purchased land for the future development of a new factory building on 31 March 2019. Okay, guys, this is in our prior year. Due to recent availability of factory buildings in the area, Impact sold the land at an amount of 1,620,000 on 1 January 2020. The original cost amounts to 1.2 million. The land is measured according to the cost model in terms of IAS 16. The proceeds from the sale of the land is a receipt of a capital nature for tax purposes. Okay, guys, now you should actually know that. But again, now what do we do here? On the right side of your screen, I just want to explain to you the principle here. Okay, now we know that the 420,000 is included as a profit. Therefore, for accounting purposes, this 420,000 is already included in the 6.9 million at the top. Okay? But for tax purposes, we may only include 80% because this is of a capital nature. Therefore, for tax purposes, we may only include the 336,000. Therefore, this should be included. Now, then we need to identify that we need to take out the remaining 20%. Okay, guys? Therefore, the accounting rule is that 420,000 is included. For tax, the 336,000 can be included. Therefore, we now need to take out the remaining 84,000. Okay. Now, let's take this out. This relates to our accounting profit on our land. Okay, remember you may use abbreviations. This is calculations. 420,000 times 20%, and this is 84,000 that we need to take out. But what now, guys? We are also able to identify that the land is included in our deferred tax calculation. Okay, so they indicate to us that they have purchased the land for 1.2 million and then they've sold the land for 1.6 million. Okay, therefore in our deferred tax calculation for 2019, we have to include our land, and this is the, guys, my spacing here. Okay, let's say this is our carrying amount section, and we take out that column here. Okay, our land had a cost of 1.2 million. And our tax base of our land, 1.2 million, guys. Therefore, no temporary difference, no deferred tax. And our land for 2020 will now be 0. Okay. We are able to tick off land. Let's have a look at our depreciation. The tax allowances on plant and equipment amounted to 1,080,000. We're able to identify that we have depreciation of 1,051,200. On 31 December 2020, the carrying amount of the plant and equipment amounted to 3,801,600 and the tax base to 3 million. Okay guys, so they provide this to us. Therefore, immediately we are able to include this for 2020. And this relates to our plant and equipment. They provide us with the amount. And this is the 3,801,600 and we have our 3 million. Therefore, we have a temporary difference of 801,600. Okay guys, the carrying amount of our asset exceeds the tax base of the asset. Therefore, when you refer to our revision page, if the carrying amount of your asset exceeds the tax base, it's a taxable temporary difference and we will recognize a deferred tax liability. $224,448. This is a deferred tax liability. Okay, but now what will the value be for 2019? They provide us with the depreciation and the tax allowance for the year. Okay, we know that we have closing balances. Okay, so when we look at this, we need to determine what is X. Let's say this is the carrying amount minus our depreciation, and we know that the closing amount will be 3,801,600. They've indicated to us in the scenario that our depreciation is 105,200. 105,200. Therefore, we are able to identify, to calculate the carrying amount. It will be the 3,801,600 plus the depreciation 5,1,200, and our carrying amount will be 4,852,800. Going to call this calculation 2.1 and calculation 2.1, and this is 4,852,800. Right, now the same in terms of our tax base. We need to calculate X, and we know that the closing balance is 3 million. They've indicated to us in the scenario, let's just have a look, that our tax allowance is 1,080,000. 1,080,000. Therefore, this will be the 3 million plus 1,080,000, and this is an amount of 4,080,000. Calculation 2.2. Calculation 2.2 at the top, and this is 4,080,000. Right? Again, guys, this is an asset. The carrying amount exceeds the tax base. Taxable temporary difference of an amount of 772,800. We have a deferred tax liability to the value of 216,384. Let's tick off this section. Let's move on. Correction of a prior period error to the value of 360,000. On 30 November 2019, Impact received an amount of 360,000 from a customer for services that were rendered during February 2020. The accountant recognized 360,000 as revenue in November 2019. For tax purposes, 360,000 was taxed in the financial year 31 December 2019. Okay guys, so this will be revenue received in advance. It's a contract liability here, guys. Therefore, this is a liability that they need to include in their records for 2019 because this was taxed in 2019. Okay. Therefore, in our deferred tax calculation for 2019, we need to include this liability, and this is the 360,000. What is our tax base? 0. Because this has already been taxed. Guys, in 2019, when you look at our principles, remember the tax base of revenue received in advance will be the carrying amount less any amount that will not be deductible for tax purposes in future. Nothing will be deductible, guys. They've already been taxed on this. Therefore, when you look at this, our carrying amount is $360,000, which they have already taxed in the prior year, 2019, less any amount that will not be deductible for tax purposes in future. You agree with us? The $360,000 will not be deductible in future. Guys, they've already taxed it. It's a tax amount. Therefore, 360 minus 360, and it's 0. Okay, so our tax base will be 0. We will have a temporary difference of 360,000. This is a negative, a liability. Therefore, the carry amount of the liability exceeds the tax base. And when you look at our principle here, guys, carry amount liability exceeds the tax base, we recognize a deferred tax asset if there will be sufficient income in future, and this will be a deferred tax asset. Let me just include deferred tax liability, and the deferred tax asset will be 1,00800. Right, now let's refer back to our scenario, and we are able to tick off this section in terms of the prior period error.